So many first home buyers purchase a terrible first property or do not buy at all. Most of them are using strategies that worked for their parents, but the reality is that this is entirely outdated and will never land you a property that gives you financial freedom. I've helped over 300 Aussies, including 150 plus first home buyers, to purchase more than $200 million in property and over $50 million in capital growth achieved using the Buy Fair and Purchase Homes Investment Blueprint strategy. In this episode, I'm going to break down exactly what I would do if I was to start my property journey again and give you the exact step-by-step build wealth from scratch process as a first home buyer that wants to build wealth with property. Now, I'm going to get right into the point so that you can understand how I would approach it. And the first one is that I would kill the forever home myth, the power of rent vesting with a caveat. So let's start with the absolute biggest trap that keeps first home buyers broke and renting forever. The first one is that most first home buyers are so emotionally invested into what it is that they want to purchase that they want their dream home as their first home. Now, we need to start understanding that your first home is almost certainly never going to be your dream home. And this is a massive financial anchor in 2026, where it might mean that it holds you off from buying something until you're ready in 2, 3, 4, 5 years, maybe even 10 plus years, so that you can get something that you would enjoy living in more. The reality is that the dream home is not your first home. Your first home is getting you on the ladder. For your parents and your grandparents was actually hard back in the day as well. So getting into your dream home is not going to be your first home. The second point is that waiting means that the market will outrun you. When you wait for the right time, for it to feel right, for the right property to come along, it means that the market's very likely outrunning you, or it means that you're chasing your tail. If a market performs really well and you're not in it, you're not going to be able to benefit from the results that might have occurred if you were in it. Even if the market doesn't perform overly well over a 2-year period, it might mean that you've put 2 years of mortgage payments into creating some equity within that property, which is forced savings. So don't wait. Let's get you in the market. Don't be reckless because, just buying something as a fire purchase and not actually assessing it properly is not the best approach. But making sure you're ready. Once you're ready, okay, let's go. Let's get you in. Let's get you going. Let's buy that home that might not be perfect, but it means we're going to get you into the housing market and put you on the ladder. Third point, decouple where you live from what you own. Now, I'm a massive fan. I rent where I live. I'm building assets in the background all the time, trying to build assets. That's what I do. But I don't want to live where I own, unless I get to the point where I can just go and buy whenever I want, which will happen at some point in the near future. I don't have any concern about living in a home that I own. Now, the reason why that is because firstly, you're probably not going to own much of it anyway. You're in a partnership with that home. It's owned by the bank. It's owned by government to a lot of degree, and it costs you a lot more to live in it when you own it. When you're renting it, providing that you're acquiring assets and income producing assets and these kind of things, but when you're renting it, it's much more affordable. The yield is lower than the interest cost. You don't have to pay the council rates, the mortgage, the strata rates, the water rates, etc. and so forth. You don't have to pay for maintenance, outside of just normal maintenance. But if things go wrong, you've got a landlord that will protect you. You don't have to pay for insurance, so on and so forth. So vesting, it's called rent vesting, but investing in affordable income producing assets and then living in a place you might want to spend a bit more on rent than you'd normally be comfortable with doing. That's okay, because it's going to cost you a lot less than what it would if you're going to live in the property and you owned it. Okay? So live where you want, invest or rent where you invest. Next point is that smaller deposits get you in now. So understanding what deposit schemes there are available to first home buyers is extremely important. Please do not stick with this myth that you need a 20% deposit to start in the housing market. It's absolute bullshit. You can get in with really small deposits now. And I'm talking 2% deposits. We have products where you can get in with 2 to 3% and the rest of the deposit is deferred over a 5-year period. You might be able to tap into super to access your deposit. You might be able to go into a shared equity arrangement with the government. There are all sorts of different approaches now that you can take advantage of to get you into the housing market sooner. And if it means that you're getting in 1, 2, 3 years sooner because you don't need as big of a deposit as what you thought, then that might be compounding growth on a property for 3 years, which helps you then buy the next property and the next property, and so on and so forth. So smaller deposits get you in now. Make sure that you're aware of it. Speak with an expert like ourselves so you can take advantage of it. This is a very important thing when it comes to getting into the market as a first home buyer or first investor. Utilize the Tenant and Taxman to pay down your debt. Now, it's important to understand that you can build homes now where you can live in one area and maybe rent out one or two other areas. This is a great approach for a first home buyer who's wanting to build some wealth through property, because it means that you're creating some tax offsets, but most importantly, you're creating multiple streams of income that help you pay down your debt. So we can do these kind of things. Once again, it's not the dream home. Don't be fussy. If you need to get a housemate in to pay down the debt for you and help you service the loan, then do it. It's a no-brainer. It will help you build your financial position a lot quicker. And then last point to section 1 is buy the asset, not the dream. This is an asset acquisition approach. This is not the dream. I know I said it before, but it is not the dream. Okay? It's your first home. It's getting you into the market. You can now say that you're a homeowner and you can build upon that. Key point number 2. So focus on serviceability over deposit size. As I said, deposits are not as important as what they used to be. The second thing I would do is shift my entire financial focus. So most first home buyers spend 99% of their energy obsessing over the deposit. They skip the morning coffee, they pack their lunches, they track every single dollar, thinking that that's the key to buying a property. But banks don't care about deposits as much as they care about income versus debt. Okay, so understanding how clean your position is from a borrowing standpoint as opposed to a saving standpoint. Now, savings are still important. You've got to get started, as I said, but there are low deposit options for first home buyers now. So make sure that you are protecting your serviceability, you're earning good income, you're not acquiring liabilities like credit cards and car loans and personal loans and these shit things that will decline your borrowing capacity and put stress on your financial position, because that's what the banks will look at. Your borrowing capacity is your real currency. And this is the mistake that a lot of first home buyers and investors make when they start investing, is they acquire the wrong property from a numbers standpoint, and it limits them from being able to get into the second property or the third property or the fourth property. When we do this correctly and we buy within your means and we set it up into an environment where the structure's correct and the income's strong, and you're using other income streams to pay it off, we can get you into the next properties faster. Very, very important when it comes to buying your first property if you want to build wealth through property. Next point, destroy all bad consumer debt. I'm talking things like Uber Eats, car loans, credit cards, personal loans, anything that is a depreciating asset, something that's not actually going up in value. You're not using the debt to acquire income producing assets. You're using the debt, to pay for lifestyle, to go on holidays, to, go and buy new TVs, these kind of things. It might be a zip agreement, or the Video Easy agreement used to be one that would come up on your credit card statements or on your credit file statements that could destroy your borrowing potential. Bad consumer debt will not help you in any way or form. One credit card could cost you $20, $30, $40, $50,000 in borrowing capacity, which might mean that you can't get into the market. It might mean that you are getting into the market in a way that's not really going to set you up for success. So making sure that your consumer debt is in check and is protected and is set up properly, and ideally you don't have any of it. Next point is cleaning up your statements. What I like to say to people who are investing in property or acquiring property is that it's almost like a court case when you're going to the bank to ask them for $500,000 or $600,000 or $700,000 in loans so that you can buy a property. You have to put your best case forward. It's almost like a court case where you're presenting to the lawyer, to the judge, to the opposition, to make sure that they're going to be comfortable in borrowing you that amount of money when it comes to it. So cleaning up your statements, making sure that you're not spending money on crappy things, drinking, gambling, these kind of things that they will find in your transaction accounts. They will find them and they will see them, and they will judge the value of your character based on the activities that occur within those statements. So before you submit for finance, make sure, and this is what we're talking about before about being in a position to protect your borrowing capacity, make sure you're creating a beautiful case to submit to the judge to give you a favorable response. And then increase or diversify your verifiable income. So the more income that we're making, especially when we don't have too much debt, the more that the bank is going to borrow us or lend us when it comes to purchasing a property. So if you can add value to your job, you can add an extra income stream, or you can get a promotion. You might go to the boss and push them for a pay rise. All of these things are good things when it comes to borrowing and acquiring more property. Key point number 3, so exploiting the 2026 government cheat codes. So let's talk about the legal unfair advantages that most people completely ignore because they think that the paperwork is too hard. What I'm talking about here is government schemes and incentives. Now, there are more first home buyer schemes than ever before. If you don't know what they are, speak to an expert, speak to a broker, come and speak to us, so that you can understand what opportunities are available for you. There are low deposit options everywhere. 5% deposits for first home buyers that are backed by the government, so you don't need to pay any lender's mortgage insurance. There are deferred deposit programs which allow you to get in with a 2 to 3% deposit and pay the remainder of a 10% deposit plus costs off over a 5-year period, 5 to 10 year period. There are shared equity products with the government where they will buy 40% of the property that you're purchasing and you can acquire 60%, which also means that they'll pay for 40% of the mortgage, so on and so forth. So your deposit schemes that are available could be the difference between you getting into a property now and in 2 years' time. So if you can take advantage of it, make sure that you know what's available, speak to an expert, get some advice, and prepare yourself for that because it might mean that you can get in a lot sooner than what you originally thought you could. Sometimes there's stamp duty concessions as well that will save you money. I'd always encourage you to use a proactive mortgage broker. I do think that working with a bank directly when it comes to lending is risky. A broker will have access to 40 or 50 lending solutions and he will assess it. They're legally required to assess it to make sure that you're getting the best deal that you possibly can as a consumer borrowing from a bank. So using proactive mortgage brokers, we use the best mortgage brokers in the industry. It's very important to what we do because if we don't have a good broker, we don't have confidence that our consumers or our clients are going to do well also. Next point, don't navigate government websites alone. Use someone that's going to be able to assist you. Come and speak with us if you like. Government websites can be overwhelming. They're extremely detailed. They're not very user friendly and they don't look great and they're not easy to use. So I would say if you're looking into this space, try and go to a first home buyer expert or a building expert or someone that can help you, to understand what the landscape is. And as I mentioned before, the right broker ticks every box for you if you can use someone that's going to go to work for you. Don't just go with someone that you think's going to just do the easy job. Get someone that you think's going to do the hard work or do the hard work for you to make sure that you get the best outcome possible. Point number 4, hunt in micro markets, so where to buy in 2026. So you've got your strategy, your borrowing power's optimized, and you know which government schemes you're using. Now comes the big question, where do you actually buy? There's a few key points to this. As I said earlier, we don't want to be acquiring a strategy where we're looking for the dream home. We want to acquire a strategy where we're acquiring a property that we are confident is in an area that's likely to perform well, that's going to generate a good yield for us and help us expand into more assets as opposed to limit us from expanding into more assets. Prime example, if you have an $800,000 borrowing capacity, I would encourage you not to go and spend $800,000 on the property that you buy because that means that you will be a lot less likely to get funding for the second property, which could make a big difference in your overall outcome. So point 1 with this is trying to ignore national property market headlines. I'm really just not a fan of the media. The media often is promoting their services or promoting their stories based on a fear element. They want to predict bad outcomes and these kind of things. Work with an expert who understands the market and understands the landscape as to what's happening across the different micro markets within the country. Obviously, there will be all sorts of different things that come out in the media. Sometimes they're accurate. A lot of the time, I feel like they're sprinkled with a little bit of fear. So the media has been wrong many times for many years. Okay? So I would really limit how much I'm influenced by market headlines in the media. No single property market exists as well. So what I'm saying by that is that there are markets within markets. There are so many variables to so many different markets in so many different regions where it can really become overwhelming. As a first home buyer looking to invest, the market that we want to look at is probably in the new home space, I would imagine, especially if you're going to transition it to an investment. We want to be able to get the negative gearing impacts and these kind of things. We want the tax concessions when it comes to capital gains. So I would say the market we're probably going to look at is the new build market. Okay. Another single market that we could look at within that range is, okay, which region are we going to be looking at? What area is going to be affordable, that doesn't stretch our borrowing capacity too far, that's also going to give us good scope for growth and the opportunity to generate a decent yield or a decent return once we lease it out. Target major areas as well. So major areas with infrastructure spend. So are the government investing in arterial routes? Are they investing in hospitals? Are there new schools going into the area? Is the private market investing? You know, one way to usually know when an area is pretty good to invest in is when there's new Bunnings or Coles or Woolworths or Aldi's, or because these companies invest huge amounts of resources into understanding which areas are going to grow in value. Okay, and the main driver for them is that more people are going to be living within those regions, which gives us confidence that you're investing into a good area. If you're going to build, it might mean that you're investing into a master plan community with a really reliable developer who also has access to infrastructure spending reports and these kind of things, so that you can make a good decision with getting into that first property. Diverse local economy is a non-negotiable, so we want different things driving the local region. Okay, we don't want to go into a single industry town when there's only one thing driving the whole town, because if that crashes, then we're in trouble, everyone leaves and the housing market crashes. We want different things that are attracting people to that area. Good schools, good transport, good education, good facilities, amenities, sporting complexes, culture and community, having a council that invests into the area. The sidewalks are safe, the crime rates are low. It's not driven by one area of the economy. The next point, looking for demographic shifts in suburbs. So, it might be that a suburb's becoming younger, and we can track these kind of things. If an area is transitioning from more investors to owner-occupiers, it might mean that it's quite a favorable area from a family standpoint. It might mean that you're going to have a nicer environment for your tenants to live in when you start leasing it out, which could also mean that you generate a better return from a capital growth standpoint. So it's very important to understand these kind of things. The next thing I would say that's really critical is that numbers matter more than emotional connection. You are assessing this based on the dollars and cents of the investment or acquisition, not the emotional standpoint. It's not so much about the floor plan. It's not so much about how big the backyard is or what the color of the curtains are. It's about the numbers. Okay, this is a vehicle for you to build wealth for yourself in the future. Okay, this is not the dream home. And then look into state and regionally if need be, but that's pretty hard as a first home buyer, because I think you need to be taking advantage of the government grants and these kind of things, and usually you can't do that if you're buying something in another state. So I wouldn't really focus too much on that. And key point number 5, this is the last one. Please stop being fussy, emotional, and overthinking. These are things that nobody wants to hear, but it might be the most important thing of all. Okay, not being fussy is incredibly important, because when you're too fussy, it creates what we call as analysis paralysis. And analysis paralysis is wealth's biggest enemy. Wealth likes speed. It likes activity, cause and effect. If you're waiting because you're spending so long assessing every opportunity and you're looking for the fine detail things that might affect it slightly over a certain period of time, you're putting yourself under too much stress. Okay, I see first home buyers in particular get scared, they're emotionally invested, and they actually don't acquire anything, or it takes a long time to do so. So analysis paralysis is wealth's biggest enemy. Second point to this section is that the perfect deal does not exist. Start anyway. It doesn't have to be perfect. It doesn't need to be the exact thing that you were looking for. If it's an opportunity that fits within your strategy, fits within your budget, and that you can make work from a living standpoint if you're going to buy it and get the government grants, then just get started anyway. Time to get going. Let's make this happen. Let's acquire assets. Let's start building. So emotion kills more deals than any bad markets do. Okay, this is not an emotional decision. This is dollars and cents. It's a numbers game. Every week that you wait costs you money. And that money that it costs you can also be compounded. So let's get the emotion out of this. You're a first-time investor. You're not investing in something that is the dream home here. You're investing in something that's going to build wealth for you. Done is better than perfect in property. Let's get started. It's the people that have time in the market that do better, as opposed to the ones that are timing the market or trying to time the market, as I say in almost every episode that we do. And then the last point here is to commit to the strategy. Trust the process. If we're not ever selling, even if you've generated a really good return in your first property when you didn't expect that to happen, some people see dollar signs and they want to sell and they want to cash in and liquidate and do all of those kind of things. Don't do that. If the strategy is to build wealth over a long period of time, we now know that not selling is incredibly important towards that strategy. So stick to it, okay? I know it gets scary sometimes, but stick to it. it will pay off. So to wrap it all up, if I was starting from scratch in 2026 as a first home buyer, I would not let headlines scare me. I'd buy an affordable investment property first to get my foot in the door. I would clean up my financials to maximize my borrowing power. I would leverage every government scheme available, target high growth micro markets, look for properties where I can manufacture equity and also income, and I would stop overthinking and actually get started. Property investing isn't about being lucky, it's about having a clear, repeatable strategy and the discipline to execute it. Now, if you're listening to this and you're ready to stop waiting on the sidelines and you're interested in understanding how to build wealth for yourself through property, there's a link below in the description where you can book a call with my team to see if we can help. And if you found value in this, please hit the subscribe button, leave us a 5-star review, and share this with a friend who is looking to make their first move in property. Thank you.